January 1st, 2026. At 95 years old, Warren Buffett takes his final bow. In 1965, one Berkshire Hathaway share was worth $19. Today, it is worth nearly $750,000. Warren Buffett became the most influential and successful investor in modern history. But behind the legend lies mistakes, obsession, controversy, discipline, and sacrifice. So how did a newspaper delivery boy build a trillion-dollar empire? This is the story of the Oracle of Omaha. Warren Edward Buffett was born on August 30th, 1930, in Omaha, Nebraska. His father, Howard Buffett, was a stockbroker devastated by the 1929 market crash. His mother, Layla, suffered from severe undiagnosed bipolar disorder. Her emotional outbursts terrified the Buffett children. To escape chaos, young Warren found refuge in numbers. At just 6 years old, he bought 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents. He resold each bottle individually for a profit. But Warren was not just selling soda. He was already studying consumer behavior. He searched trash bins for bottle caps to discover which brands were most popular. At age 10, his father took him to visit the New York Stock Exchange. That moment changed his life forever. To Warren, money meant freedom. At 11 years old, he bought his first stock. Shortly after buying it, the stock collapsed. Panicked, Warren sold as soon as he recovered a small profit. Later, the stock skyrocketed. That day, he learned a lesson that would define his entire philosophy. The stock market transfers money from the impatient to the patient. In 1949, Warren applied to Harvard Business School. He was rejected. At the time, he felt destroyed. But rejection became the greatest opportunity of his life. Instead, Warren joined Columbia University to study under Benjamin Graham. Benjamin Graham was the father of value investing. While most investors chase trends and speculation, Graham focused on intrinsic value. He taught Warren to ignore emotions, ignore noise, ignore Mr. Market, buy great value at a discount. Warren became Graham's best student, the only one ever to receive an A+ from him. One Saturday, Warren traveled to Washington, D.C. to visit GEICO without an appointment. He spent 4 hours speaking with executive Lorimer Davidson. That conversation changed Warren's understanding of business forever. He discovered the power of insurance float, money collected today, but paid out years later. Essentially, billions of dollars available to invest for free. Warren invested 65% of his portfolio into GEICO. It became one of the greatest investments of his life. In 1956, Warren Buffett returned to Omaha and launched Buffett Partnership. He started with just $100 of his own money. The rest came from family and close contacts. Warren was obsessed. He analyzed financial reports day and night, searching for cigar butt investments, cheap companies nobody wanted, but still containing one last puff of value. In 1958, Warren bought his first house for $31,500. He considered it a terrible financial decision. To him, every dollar spent was a soldier no longer fighting in the market. Soon, Buffett began taking activist positions in companies. He pressured management, unlocked hidden value, forced restructurings. Then came the company that changed everything, Berkshire Hathaway. Originally, Warren only wanted a short-term profit, but after a conflict with management, emotion took control. Out of anger, he bought enough shares to take over the company. Years later, Warren would call Berkshire Hathaway the worst investment of his career. But that mistake became the foundation of a financial empire. In 1959, Warren Buffett met Charlie Munger. Their connection was immediate. Charlie completely transformed Warren's thinking. Until then, Warren focused mostly on cheap companies. Charlie taught him something revolutionary. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That philosophy led Buffett toward legendary businesses. In 1972, Berkshire acquired See's Candies. At first, Warren thought the company was expensive, but Charlie saw something deeper. Brand power, customer loyalty, pricing power. See's Candies became one of Buffett's greatest lessons. A business capable of raising prices year after year without losing customers. From that point on, Buffett stopped chasing cheap assets. He started buying exceptional businesses. In 1988, Warren Buffett made one of the most iconic investments in financial history, Coca-Cola. Wall Street believed he was crazy. The stock had already tripled. The company had just suffered the disastrous New Coke failure. But Buffett saw something different. People were emotionally attached to Coca-Cola. The brand had become part of culture itself. Warren invested $1.3 billion, nearly a quarter of Berkshire's net worth. The investment generated tens of billions in profits over the following decades. Coca-Cola confirmed Buffett's ultimate investing formula: strong brands, loyal customers, long-term compounding. Despite his genius, Buffett made major mistakes. In 1993, Berkshire acquired Dexter Shoe. Buffett believed the company had a durable competitive advantage. He was wrong. Cheap overseas manufacturing destroyed the business. Worse still, Buffett paid for the acquisition using Berkshire stock. Those shares would later become worth more than $15 billion. Buffett later called it one of the worst deals of his life. Then came the dot-com bubble. While investors rushed into internet stocks, Buffett refused. People mocked him, called him outdated and a dinosaur. But when the bubble collapsed, Buffett survived untouched. Once again, patience defeated hype. Over time, Buffett realized something extraordinary. His greatest asset was no longer money, it was trust. During the 2008 financial crisis, major banks desperately needed credibility. Goldman Sachs, Bank of America. When Warren Buffett invested in them, markets calmed down. Not because of the cash, because of his name. Buffett negotiated incredible deals. Preferred shares, guaranteed dividends, stock warrants. His reputation alone generated billions. Meanwhile, Warren maintained the image of simplicity. McDonald's breakfast, an old car, the same house since 1958. Whether authentic or strategic, the image became legendary. In 2023, Charlie Munger passed away at 99 years old. Buffett called him the architect of Berkshire Hathaway. Without Charlie, Berkshire would never have become what it is today. In 2024, Berkshire's Apple position reached nearly $174 billion. Then in May 2025, Warren Buffett announced his succession plan. Greg Abel would become CEO. An era was ending. Yet Buffett promised one final thing. He would never sell a single Berkshire Hathaway share. For 60 years, Warren Buffett outperformed the market, nearly doubling the annual returns of the S&P 500. But Buffett's story is more complicated than pure genius. He benefited from timing, connections, America's economic boom, and Buffett himself admitted it. The luckiest day of my life was the day I was born. Still, luck alone cannot explain 60 years of extraordinary discipline. Warren Buffett was privileged, but he was also relentless. He was controversial, yet admired, part legend, part human. And perhaps that is exactly why the world will never forget him. Because even after his departure, one lesson remains timeless. Patience pays, impatience costs. Warren Buffett learned that lesson at 11 years old. He carried it for the rest of his life. And maybe we should too.